All right, let's jump right in. September has kicked off with some serious market turbulence, right? So if you're looking at your portfolio wondering what on earth is going on, and more importantly, how to navigate the month ahead, well, you're in the right place. We're going to break it all down and give you a clear playbook.
So let's get right to it. The big question on everyone's mind is, why? Why did the markets stumble right into September? I mean, August was relatively calm, and then bam, right after Labor Day, it felt like we hit a wall. That's exactly what we're going to unpack here.
Okay, first up, let's just set the scene. That first week of September, it wasn't just some minor dip. Nope, it was a real jolt to the system. You've got this battle going on between these stubborn economic headwinds on one side, and on the other, this big hope for a policy shift from the Fed. And look, the really telling thing here wasn't just that the market dropped, it was how it dropped. We're talking a broad sell-off. It wasn't just tech getting hammered. Sure, the Nasdaq led the way down, dropping 3.6%, but the S&P 500 and the Dow were right there with it. That's a classic risk-off signal. Investors were selling everything. Now, a huge piece of this puzzle is the bond market. You've got Treasury yields creeping up to around 4.5%, and that creates some serious competition for stocks. Think about it. Why would you risk your money in the stock market when you can get a pretty solid and much safer return from bonds? It just puts a ton of pressure on stock prices. And you can literally feel the mood shifting. Just look at the VIX, what everyone calls the market's fear gauge. It's spiking. And when the VIX goes up, it means traders are buckling up for bigger price swings and a whole lot more uncertainty. Yeah, the calm, quiet days, they have officially left the building. And if that wasn't enough, we've still got inflation stubbornly sticking around. The core PCE, that's the number the Fed really cares about, is sitting at 2.7%. That's still way above their 2% target. And, that really complicates things for the one institution that everyone has their eyes on right now. Which, of course, brings us to the main event. All this craziness, all this volatility. It's not random. It's all leading up to one thing, a massive decision from the Federal Reserve coming later this month. Yeah, the market is laser focused on a few key dates. So we've already had the jobs report, but the really big one is the CPI inflation data on September 11th. That's like the final piece of the puzzle before the Fed meets on the 17th and 18th. You can bet every trader has these dates circled because any one of them could trigger a huge move. But here's the wild part. Even with inflation still being sticky, the market is basically betting the farm on a rate cut. We're talking a 90% chance being priced in. This huge expectation of cheaper money, that's the light at the end of the tunnel for a lot of traders. And it's absolutely central to the playbook we're about to lay out. So this is the million-dollar question, right? How in the world do you trade this kind of market? You've got high volatility on one hand and this giant Fed decision looming on the other. This is where we get into the practical stuff, the 5 core strategies from the analysis. Okay, so here's the game plan in a nutshell. It's a 5-step approach. 1, buy the dip. 2, diversify your assets. 3, rotate your sectors. 4, focus on quality. And 5, play the volatility. Simple, right? Let's break down those first few and see what they actually mean. All right, first up, buy the dip. Now, this doesn't mean just buy anything that's down. The key here is to be strategic. The playbook says to target pullbacks in small cap stocks and cyclicals. Those companies that really thrive when the economy is humming along. Why? Because historically, these are the exact groups that get the biggest rocket boost after the Fed starts cutting rates. Next, strategy number 2. You've heard it a million times, but it's crucial right now. Don't put all your eggs in one basket. With inflation and potential tariff risks still out there, it's just smart to diversify. We're talking about things like corporate bonds, gold, maybe some REITs for real estate exposure, and even industrial metals like copper. Think of these as a buffer, a hedge in case the stock market stays choppy. And that brings us to number 3, sector rotation. This is all about being in the right place at the right time. So if the Fed cuts rates, the thinking is you'll want to be overweight, meaning have more of your money in sectors that love lower borrowing costs. That's stuff like consumer discretionary, housing, and financials. And on the flip side, you might want to be underweight the more defensive plays like utilities and healthcare, because they don't get the same kind of kick from a rate cut. Okay, so that's the high-level strategy.
It's great in theory, but what does it actually look like in the real world? Let's get specific. Let's talk about some of the actual stocks that analysts are watching right now based on this playbook. First, let's look at a category that kind of marches to the beat of its own drum: biotech and growth. These companies are a different breed. They're often driven more by things like a successful drug trial or some new innovation, not so much by what the broader economy is doing. It's a whole different kind of growth potential. So, a few names popping up on the radar here. You've got Mineralist Therapeutics, which analysts see as having a massive 155% potential upside. That's huge based on its hypertension drugs. Then there's Bridge Biopharma, which focuses on genetic diseases, showing a really solid 23% upside. And Hualan Biological is another interesting one to keep an eye on in the vaccine world.
All right, next up, and you knew this was coming, tech and AI. I mean, even when the market gets shaky, the big long-term trends like artificial intelligence and the cloud, those are just undeniable forces. The trick, according to the analysis, is to focus on the big dogs, the leaders of the pack.
And yeah, no big surprises on this list. Of course, you've got Microsoft, a top pick because it's just dominating in both AI and cloud. You've got Alphabet and Amazon, both highlighted for their own powerful AI-driven growth. And then for a slightly different flavor of tech, there's Western Digital, which is seen as having a lot of room to grow.
But look, it's not all about shooting for the moon with high-growth stocks. Especially in a volatile market like this, having some value and defensive plays is absolutely critical for balance. We're talking about those solid, steady companies with strong financials, reliable earnings, and usually a pretty nice dividend to boot.
So for example, you've got Post Holdings, the food company, showing a solid 21% upside. You've got Verizon, a classic defensive play that pays you to wait with its hefty 6.16% dividend yield. Target is on the list because it just looks cheap, trading at only 11 times earnings. And then there's a name like P&G, offering that slow, steady, reliable earnings growth. These are the kinds of stocks that can really anchor a portfolio when things get stormy.
So it all comes full circle, doesn't it? We started with a choppy, uncertain market, and that hasn't changed. But now you have a playbook. So the real question becomes, is all this volatility a risk you should be hiding from, or is it an opportunity just waiting to be seized? With this framework in mind, well, that's for you to decide.